So, with all of that said, I did realize it's probably a good thing to point out some connotation and context as to who I am and how I see the world, because obviously I have some, nuanced opinions in the way I see the market, and I'm going to start and end with anything can happen. I could be wrong. I could always be wrong, and that's important. And so can you. Nobody knows until it's over. The only, and I say this very contextually, I don't mean this in like the SEC's definition, I mean this as a personal definition. The only guarantee that you have is after the fact, right? So you can't change the past. Certain numbers, like, for an investment, say it has like a 10% return, say it hit 10%, plus or minus 1%, maybe every single year for the last decade. It could or could not go to 0 or 100. Anything can happen. And that's just something that you need to understand. Even with my own personal investment strategies that I utilize and the research that I license, anything can happen, right? And as an investor, that's probably the biggest lesson that you can learn. And we'll get into a little bit more about what the thought process is for an investor and what builds a strong investment mindset. Or maybe we'll just get into it now, and I'll just go into the second part of this afterwards. But when it comes, the way I see the world of investments is anything can happen, and I find a level of comfort in probability and in pattern recognition, in certain phenomenon like momentum, and that's a really good rabbit hole to go down if you are looking at learning about market strategies. Again, this is not a call for anybody to go out and do this on their own, and I actually recommend that you don't do this on your own. Even me, I'm the owner of an investment company, right? I'm the owner of an investment firm, and even I consult different colleagues in the area and across the country in order to refine my own position, and they also do the same thing. So if you think that you're going to go out there and do all of this on your own, you're going to listen to maybe what I have to say and read an article and a book, and you're going to go out and be a successful investor, I'm telling you that is not what I recommend. I recommend you find somebody, me or someone like me, to talk to about your ideas before you go through with anything. And even then, after you've talked with somebody, maybe talk with 10 more people. And, the Dunning-Kruger effect is real. If you just started, you're going to sit there and think you know everything. You're going to maybe get, quite literally lucky with a few trades, a few investments, and you'll sink your entire position because you haven't made a refined investment strategy. And even if you did get that far, you haven't refined your mindset to be able to handle, black swan events or upheavals in the market. So my best advice to you is contact a financial professional. Everybody. I have my own network of people that I speak to refine my thoughts and my strategies, right? And if I'm doing that, you should absolutely be doing that. So, nothing is certain. Anything is possible, all right? And probabilities is where you can find some comfort. But even still, it's a probability at the end of the day. And black swan events, statistical anomalies, do appear in the market. And again, the only guarantee you have is the past, because you can't change the past. So, kind of a brief monologue on that, but it is important that everybody understands, that's the basis of investing. You've heard it before, I'm sure. Don't invest what you're not willing to lose. And that's a rule of thumb that could hold a lot of truth, but I would say to refine that down even more to something a little bit more real and understandable is, you need to have good financial principles in order to invest. So there is a time in the market versus timing the market, right? if you are going to make an investment, generally you should be sitting there saying, all right, there's a defined period in which I'm going to be investing this money, and my investment needs to suit that. And that's like one of the bare minimums. And then the strategy or the mindset needs to be that you're going to follow the strategy. And the strategy needs to be something that's tested, and it could have, and this is getting a little bit deeper than maybe I want to, but day traders, for how negative the stigma is around people who day traders at their core, the core context, if you read their literature, they tend to have the, I can't say perfect, but they have a well-refined way of looking at investments that, even though they're on a micro timeline, you can spread it out to the macro level. And they look at risk reward, right? How much do I need to put on, and how much will I get, and what's the probability? And there's more to it. There's certain ways of like extending the funds to make sure that the law of large numbers does work in their favor, or could work in their favor. But there's been people out there who have had a 10% success rate. However, their risk reward ratios were in a way that when they did hit 1 out of 10 times on their investment, and again, this is day trading, but when they did hit on that investment, they won so big that it covered the cost of the 9 other losses. And that's a really hyper aggressive way of looking at investments, but in the broader context, you can look at it and say, okay, if you have a steady income, okay, I have a steady income, I can cover my bases. Every week or every month, this amount of money I have left over. I've done my due diligence. I have good financial principles. I have money set aside for emergencies. I have, I'm trying to max out my 401k, or I am maxing out my 401k, and I have room to spare, and all of these things, right? When you're in that position where you can reasonably say, okay, now I can start setting my timeline on some of these investments. 529 accounts have a shorter timeline than maybe your traditional IRA or your 401k, right? So, you start to build out your plans and say, all right, I can reasonably expect that X will happen if I do Y. And all of that is to say, you still need to bounce these ideas off of somebody. And I'm trying to tiptoe around because, again, everybody is different. So that scenario, even though I've made that very broad, nobody should take anything from that and apply that exactly to themselves. You need to speak with a financial professional. That's my number one piece of advice. Even some of I shouldn't say some of the worst advisors, but there's going to be people out there, even if they may not be like a top tier advisor or something like that, they'll have the basic framing that should give you a decent idea of where you're starting from and where you could go, and hopefully they have enough experience that they've seen something like your situation before, and they can give you some proper advice, and that's the licensing portion, right? Like, they're licensed to be able to do that for you. So so with all that said, a lens that I look at the world is, and I said this on my video the other day, and I do want to say, all right, I'm just going to say it. It's not how, or I'm telling you how it is, not how it should be.